I think the message that I've been telling our clients and the people that I've been speaking to is really that this level of uncertainty highlights the need for, real diversification. It's not, I would argue it's not actually possible, similar to like we talked about earlier, to come out with a one cohesive narrative that explains everything that's going on that would lead you to believe that, hey, you should own this asset over this other asset, 100% certainty. I think that there are shades of gray to every aspect of this. And what this level of uncertainty does is it makes it very difficult to get a high degree of confidence behind your predictions. You can look at every data set out there, and there's more noise in the data than ever before. It's harder to get reliable data. It's more difficult to synthesize that data into a compelling narrative that makes sense over a long enough time scale to put a trade on to build a portfolio. So, what we've been saying is effectively build a diversified portfolio, maybe take risk down a little bit in the short term, because if you believe that we are in for more of the same, more uncertainty, more uncorrelated executive orders and political fiscal decisions. We have elevated interest rates that are nowhere near, where they would need to be for a real pivot to a risk on, high liquidity environment. And there's all this geopolitical uncertainty with respect to Ukraine, with respect to China, with respect to all these kind of hot button issues that you were seeing across the headlines on a daily basis. So, the safety trades make sense. Fixed income at this point, is more attractive than it's been in the last 20 years. So, when you look at real yields and you compare them to expected returns on equity assets, I mean, you can go look at any, major buy side shops, capital market expectations.